Let's start with cost of capital. This is slightly advanced compared to your level one, but not so complicated because most of the things by now you must have already covered in equity or fixed income. So let's begin with the basics of cost of capital. There is going to be a lot of formulas and calculations involved. So we will write down most of the formulas. Now, I'm sure you all are aware about the basic formula of cost of capital, which is what we also call as weighted average cost of capital or simply WACC, correct? Weighted average cost of capital, which is weight of debt into after tax cost of debt. Remember, debt is interest is tax deductible, right? So weight of debt into after tax cost of debt. I write it KD, they write it RD, doesn't matter. So this is before tax. 1 minus T is after tax cost of debt plus weight of equity into cost of equity. Of course, there is preferred also, but as of now, we are assuming in this topic that there's no preferred equity. So there's common equity and debt, right? If there is a preferred equity, you can do the weighted average of that as well. Now, the reality is that for cost of debt, there are not too many varieties because it's actually YTM, right? But for cost of equity, everything is uncertain. The dividend is uncertain, the price is uncertain, unlike debt, where the interest and principal and the maturity is certain. Correct? So cost of equity is more complex. There are different varieties of assuming what cost of equities will be there, and there are a lot of theories, including the most famous CAPM, capital asset pricing model. So throughout the topic, we are going to understand different varieties of calculation of cost of debt and cost of equity. We'll begin with cost of debt, then cost of equity, and we will see what are the problems when it comes to a public company and not listed company. In that case, what are we supposed to do? Correct. In between, there is some theory with respect to after the calculation, you will see there is some theory related to what are the factors that affect whether you should go for debt or equity. So it is also going to talk about the different types of capital structure, but not so in detail because that we will study later. But it is going to tell you one very important thing, that whether you should go for debt or equity and what are the factors that companies prefer. Because see, debt is cheaper but has risk, correct? Equity is very equity, you don't have a compulsion there, right? So let us understand what are the factors that overall impact the cost of capital. Now before I discuss the factors, remember, you always want the cost of capital to be lower, right, everyone? Correct? Yes. Sorry. So let's start with cost of capital. Now, first of all, when you go to borrow debt or raise capital through equity, correct? The important thing is that the riskier the company is, the more costlier will be the cost of funding, right? Now, there are two primary factors which we all know are systematic and unsystematic, which can be summarized here as top down, which is external or macro factors which affects all the companies in the industry or sector. And then the second part definitely is the unsystematic risk or bottom up factors. These are company specific factors, right? So what are the top down factors? We will just note down here, no need to go in detail. One is the availability of capital in the economy. So easy access to capital will definitely lower the cost of capital, right? Here there is one word that they've highlighted, shadow banking system. Shadow banking is an unregulated banking system, which is not through the bank source, but non-banking companies. These can be traditional companies. This can be legal, illegal, various different sections of the economy work in this manner. For example, everyone who is from India, they know that the fact that there is an alternate banking system which is much bigger than the traditional banking system, right? So that's a shadow banking, correct? Market conditions are economic conditions. If the economic conditions are positive, if the inflation is under control, then the cost of capital is low. Otherwise, if the interest rates will be higher if the inflation is very high. So markets being volatile, the cost of capital will be higher, right? Legal and regulatory considerations. Yes, this is very important. Here, there are two things: common law common law countries and countries which have a civil law legal system. So, can someone tell me what is a common law legal system and what is a civil law legal system? What they are trying to say is that Countries that follow common law, they offer a stronger protection to investors compared to countries which follow a civil law based legal system. Now, in reality, there is no such exact meaning of what is a common law based country system, legal system, and what is a civil law based legal system. But just to give you a gist about what exactly it means, so common law system and civil law system. Now you can individually define which country falls under this, or your country whether falls into common or civil. Okay, so common law based legal system is where the law is based on the legal proceedings of the court, that is by the judge. Correct. So common law is law based on the legal proceedings, based on legal proceedings. Now, to be honest enough, many people have different versions of what they actually mean by common law and civil law. This is what I have known what common law system is. So, under a common law legal system, whatever is the court's order, that's the final order. Now, that's not unfair, right? But what is a civil law legal based system? A civil law based system is the one where the constitution is the final word. Means the law is prepared or finalized by the constitution, which is made up of those who are in the constituency, those who are in the parliament, those who are in the assembly, those who are part of the, those who are elected in the government, or those who are elected, in the voting, in the voting scenario. Those people, those legislatives, they prepare the legislation. Correct. So it is the legislative which prepare the constitution, and that is the final word. So this is the system. Now what they are saying, that no, countries where legal proceedings are more valued, or they have a more say, that's where there is more protection for investors. So everything goes according to the law. So if you remember from level 1, we had discussed priority of claims. What is priority of claims? That when the company shuts down or gets bankrupt or liquidated, senior bondholders are paid first, then subordinates, right? Do you remember this priority of transactions or priority of payments when the company goes bankrupt? Correct. That should be the case, right? However, in reality, it doesn't happen that way. Why? Because then in a civil law based legal system where the issues go to the court, and what happens is that because people are fighting, and there is a possibility that the law can be changed. So the reality is that that is not always followed. However, if it is exactly followed as per the law, then it's a common law system where the investors feel more protected. Got it? Now, there is a tax jurisdiction. Remember, cost of debt is 1 minus T. So, higher the tax rate, the more cheaper it is for you to have cost, because after tax cost is low. So, countries where there is a tax deductibility of interest, these countries, companies will prefer to go for debt. Got it? Clear? These are macro factors or top down. They will affect all the companies, right? Now, when we come to bottom of or company specific factors, most of the things we've already discussed throughout the syllabus. Here we have business or operating risk. Business or operating risk means how stable is your revenue or cash flows, correct? Is your business cyclical or not? Are you having few customers or too many customers? That is called customer concentration. If your revenue is coming from very few customers or a specific location only, then you are in a risky zone. Correct? So this is your operating risk, right? Second, asset nature and liquidity. Here, remember, when you go for borrowing, you need to put collateral, right? The tangible collaterals are more specifically valued, like property or any other asset that you put as a collateral. That type of collateral will give you much cheaper funding, because lenders pursue that as a higher recovery rate. They have a higher recovery rate if it's a high valued property that you put as a collateral, or a treasury security that is a collateral. So the quality of asset or the liquidity of asset will also impact the cost of your capital. Financial strength and profitability, I need not say higher the profitability ratios, the lower is the probability of default, and therefore lower is the cost of funding, right? Security features. If let's say when you issue a bond, if the bond is callable, then investors find it more riskier than a puttable bond. So any bond that the investors find less riskier, the cost of that bond, what I mean is that the yield on that bond can be lower. So you can issue the bond at a lower YTM. For example, a put option or a conversion option on the bond will make it affordable, will make it very exciting for the investors, and therefore the cost of capital for the company will be lower because they can issue such bonds at a lower yield or a premium price, correct? Same goes with cumulative preferred stocks, where investors are certain that they will receive the preferred stocks if the company has missed it in the past. Again, all of these, or different classes of equity shares, that like Warren Buffett has class A, class B, right? Berkshire Hathaway has class A, class B shares, or Facebook has different class of shares. So these different class of shares, or Tata Motors, an Indian company which makes Jaguar, Land Rover, they have differential voting rights. So different class of shares comes at a premium, and therefore companies can reduce their cost of capital by putting some features on the funding options that they go with, either bonds or equity. All of this can lower your cost of capital. Clear? Got it? The basics. Now let's start with first debt, and then we move on to equity. So first discussion will be all about different types of cost of debt. Okay. Tell me one thing, are bonds listed, unlisted? Most of the bonds are, most of the bonds are unlisted, right? Correct? They are not public. Very few bonds are public, especially if the company is very high valuable or very noteworthy or very credible company in the country. For example, ADNOC in UAE, or Saudi Aramco in Saudi, or Apple, or any other company which is everyone is aware about. Then these bonds are in high demand and they are very well traded, but still they are not as much as traded, or the liquidity is not as high as the government bonds. So bonds, most of the bonds are actually not traded, right? So first we will discuss about what are the different ways of calculating cost of debt. First part, public debt, and the second part of those debt which is not listed, or even if it is traded, it is very thinly traded, because as I said, there are very few people willing to trade in the bond market. Bond market is not as active as the equity market. It's OTC in nature, right? So we will first talk about public traded debt, then we will talk more about the non-traded or thinly traded debt. And we will also talk about those type of debt which are issued in the global market. That is when we are doing international issuing of bond. This is where currency will come to picture, right? So there are three varieties that we are going to consider now when it comes to cost of debt. Everyone with me? Got it? Yes. So let's first start with public debt, non-traded debt, and then we will focus on the international consideration, right? Very easy. If the debt is already listed, if the bond is listed, then you have all the components. You have the face value, you have the maturity, you have the coupon, right? What else do we need? We need the price of the bond. So if the bond is already listed in the market, you have the price, PV of the bond. This makes it easier for you to calculate the YTM on the bond. So that YTM on the bond is nothing but my cost of debt before tax, correct? So what is YTM? YTM on the bond is nothing but my cost of debt, right? That's possible if a company's bond is listed. So see, if a company's debt is publicly traded, the YTM, but which YTM, long term or short term? Generally, it's preferred first to go for long term, because see, companies are issuing capital for long term, right? So if you are going to raise capital for long term, then you will look at long term bonds in the market, right? So YTM for the longest maturity debt outstanding is the company's best estimate of cost of debt. Understood, everyone? Correct? However, if the company's bonds, long-term maturity bond is less traded or thinly traded, then the second option is you can also go for short-term debt. Everyone, correct? So first preference is long-term debt, but if it is not, then you can go for, if it is not traded actively, then you can go for short-term debt. This is very easy because the bond is already listed. So you can take the price and use that price in case of a publicly traded debt. So when we are now discussing cost of debt, right? Let me start first in case of cost of debt, which is my after tax cost of debt basically. So you can also write it as after tax cost of debt. First, if it is public traded debt, then simply go for your cost of debt is simply your YTM. Understood? Of course, you can do 1 minus T. And YTM, first preference is you will go for long-term bond. And if it is thinly traded, then you can go for short-term, long-term or short-term. Clear? So in exam, whatever situation they give you, whatever inputs they give you, from that you get the YTM, I by Y, and 1 minus T, that is your after-tax cost of debt. Very easy, simple, no-brainer here. Now we will look for private or thinly traded bond. In that case, what are we supposed to do? That is what we will now check. Okay. First of all, remember for privately issued bonds or bonds which are not listed, okay, or thinly traded, they generally, we don't say private, we say non-public bond, okay. So they use a word non-public, I say unlisted bonds. So non-public bond, the reality is that if I'm issuing a bond, I need to match two things: the maturity and the credit rating of my bond with the similar bonds in the market. But if the maturities don't match, we do something that we did in level 1, that is matrix pricing. I'll repeat, for matrix pricing, the maturity should match and the credit rating should match. Correct? If these two things match, then definitely what we are trying to say here is that the yields will have to be almost the same. Correct? So the debt, if it is credit rated, what if the debt is not credit rated? In that case, you will match the performance of your company with the other company's performance. For example, some of the ratios that they've mentioned, interest coverage or financial ratios, leverage ratio, these are the same ratios that credit companies look at before giving you credit rating. So if the company has credit rating, correct, then you will match the credit rating of the bond that you're planning to issue and maturity. If the maturities don't match, you are now going to do matrix pricing, which we did in level 1. Don't worry, I will start it from the scratch as to how to do matrix pricing. And this is when you have the, you will do matrix pricing if you yes, if you have the credit rating. Okay, if you don't have the credit rating, in that case, you will look at the performance of the company that is issuing the debt with vis-a-vis the identical companies, and then accordingly you will try to put the yield. This is what generally we do when we are planning to issue a bond. Okay, so when using the credit rating, they've mentioned some things. Realize that the issuer rating may be different than the issuer's individual series debt. If you remember, when a company issues bonds, it issues several bonds. So not each bond is rated at the same credit rating. So individual issue rating may be different and the corporate credit rating is different. So let's say company issues varieties of bonds. So all bonds, will they have same rating? No, one of the bond, let's say the most senior bond has AAA, assuming. Then you have, this is senior secured. Then you have subordinate bonds, right? Junior secured. Then you have unsecured bonds. So likewise, you will have several series of bonds. The most important, the most safest series will have AAA, let's say. Then you have AA. Then you have single B. But then you have one of the bond whose credit rating, let's say, is triple B. What is this category? This is senior unsecured bond. Now, why am I highlighting this category only? Because these are individual issue ratings. But of this, whatever is the rating of the senior unsecured bond, that rating becomes the corporate rating. That is the rating of the entire company, you can say, right? You don't have to remember all of this for level one, but I'm just discussing that what is that we do, because each bond doesn't have the same rating. Got it? Understood the difference between issue rating and the issuer rating? So whatever is a senior unsecured bonds rating, that rating is the entire issuer's rating also. Clear, everyone? Right? So let us understand metrics pricing, how it works. I will show you a very easy way of doing this. This is something that we did in the past in the level one also. See here, cost of debt. Sunil Tilak is trying to estimate the cost of debt, which represents 30%. Okay. See here, what I need is 6 year and double B rated. These two things are important for me. I want to issue a 6 year bond, double B rated. Okay. But what happens? Maybe this bond is thinly traded. So I look at other bonds available in the market. So now I want 6 years, but I have 4 year and 7 year bonds, similar bonds in the market. What we need to do is that we need to take the YTM of these two bonds category, and average YTM will become my 4 year bonds YTM. Okay. Now they've given you the price. If you put all of these inputs, you will get the YTM. I'm not going into detail of solving it. You can solve any particular question here and you will get the same YTM by putting I by Y. So you will put your N coupon. You can put 5 as a coupon, PV negative FV 100, and you will get this YTM. So these are your 4 year bond YTM, and this is your 7 year bond YTM. Simple average you take, add both, divide by 2, add both and divide by 2. You will get your 4 year average. They've calculated your 4 year average, or you can simply do 5.16 plus 5.5 divided by 2. You will get 5.33. Are you getting 5.33 here? And here 5.26 plus 5.53 divided by 2. 5.26 plus 5.53 divided by 2. You will get 5.395. Are you getting this? Yes. Now, once you get this, you can do an interpolation. See the interpolation that I do, right? They have done the same thing, but I generally don't prefer their method. So see, my 4 year average yield and 7 year average yield. So my 4 year average yield is 5.33. My 7 year is 5.395. Correct? So for a distance of 3 year, how much is the gap between this and this? Let's find out that. So the gap between both 5.395 minus 5.33. So that is, I get a gap of 0.065. Correct? For a gap of how many years? 3 years. However, we need to go from 4 to 6 because we are looking for a yield for 6 years. So we need a gap of only 2 years. So this entire difference is for 3 years. How much is for 2 years? So whatever is your answer, 0.065 into 2 divided by 3, you will get this as, I think you should get this as 0.0433. Add your yield for 4 year because this is the minimum for 4, and extra we got 0.0433. So just add 5.33 to this plus 5.33. I do this, I will get 5.37. Just check it if you're getting 5.3733. This is what I'm exactly getting, 5.3733. Right? They should probably be getting the same thing. They also are getting the same thing, right? I, however, do it in this manner. So whatever is the difference for 3 years, how much is the difference that I need? This is metrics pricing. Exactly the way that you must have done in level one. Got it? Everyone? Understood the metrics pricing? Check, check. Clear? Perfect. Easy. Now, this is what we will do generally when the bond is unlisted. Okay. So we will compare other identical bonds in the market. We will try to match the credit rating and the maturity. If the maturity doesn't match, then we do this interpolation or matrix pricing, whatever they call, right? This is what we will do when the maturities don't match. If it matches, simply take it, no problem. But it's not always that the companies issue bond. The most preferred choice by most of the companies is going for, instead of bond issue is good for large companies when they go for a huge amount of issue, right? But if you're going for a very short, capital, then the first preference for most of the companies, bank debt or bank loan. That's the primary source of capital for most of the companies, isn't it? Correct. So in this case, whatever is the after tax interest cost, whatever is the after tax interest by the bank, that is your cost of debt. Easy. So if you go for debt issue, then this is matrix pricing you will have to do. If you're going for issuing a bond which is not traded or which is thinly traded. If you're going for bank debt, then very easy. Whatever is the bank interest rate, 1 minus T, right? But there is another way, is that lease. Remember, leases are also considered as debt, especially finance lease. Finance lease is where you're buying property, plant, equipments at installments. They are also finance lease. Now, finance lease is also long-term liability, isn't it? So, very interesting thing, that when it comes to lease, the implicit rate in the lease, which is called RIIL, rate implicit in the lease, this rate is going to be my cost of capital if I go for lease. Many people are surprised with why lease is what we are discussing in debt, because lease is also long-term liability. Therefore, many companies consider finance lease as a part of their leverage ratio. They add it to the debt. In fact, we've seen the coverage ratios where we take lease also into account, right? So implicit rate in the lease is nothing but IRR from the lessor's point of view. Lessor is the one who's giving you the asset. So whatever return the lessor is expecting, that return, that IRR is the cost of capital. Got it? So for this, they've given you the formula. I will discuss you what exactly this formula is. This is nothing but the lessor's rate of return, which is how much is the lessor's return on the project. Remember, for the lessor, there is an outflow and inflow. The lessor is leasing you an asset, which the lessor must have bought, right? So how much is the lessor going to make from that lease? That is your cost of capital, right? So if you notice, present value of lease payment and present value of residual, this is what the lessor's inflow will be. So whatever is the inflow, on the other end, how much is the lessor going to pay? For the lesser, the cost is the fair value of the asset and lesser's initial cost. Lesser's initial cost. This is going to be your outflow, if you think from the lesser's point of view. Now, here you have inflow and here you have outflow. So whatever makes the inflow and outflow match in present value terms, that IRR is my rate of rate implicit in the lease. Yes, let me show you. First, third, what is rate implicit in the lease? That is nothing but it is IRR for the lessor. That's going to be my cost of capital. And for the lessor, what two things should match that I'm going to write here? One is the inflow, one is the outflow. So what makes the two things match, the present value of inflow and outflow, that is your IRR. Remember from your level 1 concepts, the rate which matches the present value of inflow, and present value of outflow, that rate is your IRR, and that is your rate implicit in the lease, which is going to become your cost of capital, right? So here, what are the lessor's inflow? Lessor is going to receive the lease rental. So see this, present value of lease payments. Lease payments. This is what the lessor will receive from the lessee plus present value of residual, if any. See, generally in finance lease, there is generally no residual value. However, if they give you so, you can consider it. So this is going to be the inflow, right? On the other end, what is lessor's investment? Lessor's investment is the fair value of the leased asset. Imagine lessor going into the market and buying the asset today. So what is the asset? That is called the fair value of the lease asset plus any additional cost the lessor has put in. So that additional cost is here termed as lessor's initial direct cost. So it is lessor's initial direct cost, installation cost or transporting cost, whatever the cost is. Any rate which matches these two things, that's your rate implicit. That's going to be your cost of capital. Okay. Let me show you this exactly how it works. Correct. They say that all of this information you can get it from the lease document, especially in the finance lease. This information either you get from the lease document or you can also check the footnotes. They are saying if they are not, then the incremental borrowing rate on the new secured loan over the same term can be used. So whatever is the new rate for the borrowing, you can use that. Now you can ignore this information. It is not so important. What is important is how to calculate RIIL, rate implicit in the lease. It's simply like a project, like a lesser's return on the investment. Okay, see this. Company A has signed a 15-year lease on an asset calling for annual payments of 10 million at the end of each year. So guys, 10 million is going to be my inflow. Isn't it? Isn't it? Correct. The value of the residual is 30 million. So think from the lessor's point of view, what is the lessor's inflow? Lessor will get, guys, 10 million, 10 million, which is going to be my PMT for a period of 15 years. And at the end, he will also receive one more thing of 30 million as the residual. So these both are my inflows. So they will be plus, correct? So this will be my all my inflows, right? On the other hand, they are saying fair value of the asset is 120 million. This is at the beginning. So this is going to be my outflow 120 today, right? This is going to be going in my PV and the lessor incurs a cost of 5 million at the time of lease initiation. So instead of 120, I will put 125 as my PV outflow. Isn't it, everyone? Now just go to the cash flow, or you can simply do the bond function also PMT, because the lease rental is the same. So what you can do is that you can put 125 negative as your PV, 30 as your FV, 10 as your PMT, 15 as your N, and compute I by Y. You will get 4.28. Are you getting this number easily? This is going to be your N, this is going to be your PMT, FV, and PV negative because PV is an outflow. Yes, this is going to be your cost of capital in the lease. Clear? Everyone understood? Check, check, check. Got it? Perfect. Yes. So this is generally what we do when it is unlisted, right? Now, the third thing is, what if it's an international debt? In that case, what are we supposed to do? This is what we did when it was private or unlisted. Actually, this is rate of implicit. This is when it is leasing. Now we will discuss that if there is an international consideration. In that case, are we supposed to do something? Yes, we are supposed to add something, and that something is nothing but that's called my country risk premium. So now I will put your fourth option instead of three. This is when we are doing international debt. In international debt, all you will do is that you will add one more thing, is called as add CRP, country risk premium. Now, what are we supposed to do here? See this. For foreign borrower, the cost of debt should include a CRP, country risk premium, or they say country risk rating or risk premium. Okay. Now, what is country risk premium? Country risk premium is an extra that you will be adding to the specific debt because it is issued in the international market. Now, this risk is due to various reasons, which is already reflected in the credit rating. It is due to economic, political, or any currency related risk also. So all the risks that are there in that market, here we are assuming you are sitting in a developed economy and you are actually looking at an emerging market debt, which is extra risk. Understood? So this is how the viewpoint is. Your viewpoint, I'll repeat. Let's say you are in US and you are investing in a debt in India, or let's say in Nigeria, or let's say in any other country, which is an emerging economy. So in those case, what extra risk you're taking, that's country risk premium. So your yield will be extra. Got it? Right. Now, how to do that? See, very interesting and very easy way. We will also go directly to the question. So they are saying a country may be assigned a relative rating relative to the benchmark. Okay. The excess relative to the benchmark is the country risk premium. How to do that? So see this. Country A is the benchmark. Therefore, its risk premium is zero. So imagine country A is like US. Example. Okay. So its risk premium is zero. Now I am looking for country C. How much is country C's extra? You will see this is actually like a spread, isn't it, compared to country A? So this extra spread is nothing but this is my country risk premium. So now if I'm issuing a bond similar to country A, right? Everything same, but since this is an emerging market, I will add this yield extra. Why will I add this yield extra? To reflect the country risk premium. Understood? So this country risk premium will be added. Let me show you how exactly this works. Oh, do we not have a question related to this? Let's say, here they have given country C's median interest rate is 6.8. This is their interest rate, 6.8. Now, ideally, a similar bond in country A should be 4.2. But why is this extra? This extra is due to country risk premium. So just that they've given you some extra that is due to country risk premium. Understood? Clear? Right? Now we will go into this is what international consideration is here. So you simply add the country risk premium. Sometimes they ask you to identify the country risk premium, or sometimes they give you the country risk premium, which we will be adding up in the structure, right? So these are the options related to debt. Remember, in debt, we have these many options only. Majority of the options will be, majority of the varieties you will see is with respect to equity. So just to summarize, what are the different options that we got into the understanding of cost of debt? Yes, my cost of debt, I'm rewriting it here. My cost of debt, if it's a public, thinly traded, if it's a public traded debt, non-public, if it's finance lease, which is also long-term liability. And finally, we discussed when we are going for international debt. Okay. In this all cases, we are discussing what is my cost of debt. I'm not discussing 1 minus t, that is naturally to be done every time. Okay. So we are discussing cost of debt. Public debt, simply take the YTM. For non-public debt, we want to match the maturity and the credit rating, correct? Maturity and credit rating and credit rating. For this, we will do what? We will use matrix pricing, interpolation. So matrix pricing is what we will use to calculate the cost of debt. Everyone with me? For finance lease, we use rate implicit in the lease, which is nothing but IRR for the lesser. Got it? That is going to be my cost of debt in case of, or cost of capital in case of finance lease. For international debt, simply add country risk premium. Country risk premium, which is nothing but my CRP. So whatever is the YTM of a similar bond, add a country risk premium. Clear, everyone? Got it? Cost of debt, check, check, check. Easy. Perfect. Yes. Now, the rest of the topic is all about the discussion of cost of equity. Cost of equity, cost of equity. Now, the focus on cost of equity will be generally CAPM. CAPM is what we generally use, right? If you see the CAPM's formula, what is CAPM's formula? RF plus beta, RM minus RF, right? Now, in this RM minus RF is nothing but that is what we call as our equity risk premium, which is extra that the investor demands over the risk free. Now, whenever I say equity risk premium, since we have discussed this n number of times in the topic of equity, but still to recollect, this equity risk premium is nothing but RM minus RF. Throughout the syllabus, focus that this equity risk premium is nothing but RM minus RF, RM minus RF. Got it, everyone? Right? Now, first, we will try to estimate this RM minus RF. So, ideally, when I'm looking at cost of equity, which is also called required rate of return for equity shareholders, because see how much the shareholders want, that is what is expected, because in reality, nothing is obligated by the company to pay to the shareholders. Dividend is not compulsory, price appreciation is not compulsory. So these are all different versions of what shareholders can expect. So that required return for equity shareholder is actually risk free plus equity risk premium, which is due to systematic risk. So this is where your RM minus RF is. Plus, there is one more thing, that is the premium for company specific risk, which is what we technically call as error. So that is called IRP. IRP. And what is IRP? IRP is company specific risk or company risk premium or risk premium for stock. So this is company risk premium. This is company risk premium, which in a diversified portfolio, this generally becomes zero. So our focus is going to be on ERP, that is equity risk premium, which is again RM minus RF. First, we will focus on how to derive RM minus RF, what are the different varieties, and then we will go into calculating different types of cost of equity. So there are two ways to estimate the equity risk premium. One is looking at the past historical, right? And naturally, the second option is forward looking. So there are only two options, historical estimate, and the second is forward looking estimates. We'll discuss about the both. Then we will begin the calculation of different types of cost of equity. Again, my focus is on RM minus RF, RM minus RF. Now, historical estimate, historically, you will look at the index returns, simple mean, and you will look at the treasury returns for the same period. That is the easiest way, right? Now, how to use the or how to derive the historical estimate, they have given four important issues you should consider while deriving this historical estimate. Read it, understand it, and move on. Okay, you don't have to memorize this. First of all, depending on where you're going to invest or which market you're planning to invest, you need to select an appropriate index in such a manner that it reflects your style, your strategy, or the target market. So the index which serves as good as proxy of investors' expected return, that is what it should be. For example, only if you're going to invest in US market, then you should look at S&P 500. If you're looking at global market, then you might look at MSCI, composite MSCI, global index. So you will have to look at appropriate index which suits your investment strategy. Second is sample period. Which sample that you collect is very important. Large sample is generally preferred. Statistically, larger the sample, better it is. But what if this large sample has quite a lot of older data, right? Then it is not appropriate. Then you might have to look at the data which is relevant. Small sample is generally less preferred. Large sample is preferred. But you will have to look at various sampling related issues. Otherwise, there will be a lot of sample bias, right? I'm not going into too much of detailed discussion into this. It is not required. Mean, whether you should go for arithmetic mean or geometric mean. Remember, arithmetic mean is very easy to calculate, but geometric mean is actually more impactful because arithmetic mean is very sensitive to complicated numbers. Ideally, if you remember the relation, arithmetic mean is always greater than equal to geometric mean. Geometric mean is slightly less, it is compounding, but when it comes to competition, arithmetic mean is poor because it is very sensitive to some of the numbers, and therefore geometric mean, see, arithmetic mean is a good estimate for one period but does a poor job when it comes to multi-period. For multi-period, geometric mean is better, and therefore it is more preferred compared to arithmetic mean. However, in reality we use both because most of the investors understand arithmetic mean easily, but in reality we use both. If they ask us which one is better, we will always say geometric mean is better than arithmetic mean. Clear? Now these are all the areas for you to identify index returns. Now it comes to RF, risk free. Which return should I take? Most of us generally take which returns, guys? The treasury returns, right? Should I take short term or long term? Well, that depends. That depends on how long you're going to invest. Generally, the thumb rule is that if you're going to look at invest for 10 years, then you should look at 10-year bond yield, right? The short term bond yield, however, is more better proxy because they're more traded, isn't it? They're more liquid, correct? So the short-term T-bill is a good proxy for risk-free because it does not include the reinvestment risk, isn't it? So this is generally preferred as a much accurate because see, reinvestment risk is always there and that spoils the return expectation because in equity it's very difficult to reinvest at the same rate. So this reinvestment risk looks very fancy, but it is not practical. So therefore, generally people prefer short-term bond yields, which are zero coupon yields, right? However, because the equity duration is long-term, right? Many use long-term bond yields, as I already mentioned. These are all historical estimates, and these are the four important points that you should focus when you are deriving estimate of the equity risk premium from the past. Most of the people generally derive it from the past and they do some changes if required. The problem, what are the weakness or the problems using historical? Very easy. First of all, we are assuming that the returns will be constant, that is stationary, which is theoretically an incorrect thing, right? That is first thing. Especially if this does not seem to be the case. In fact, equity risk premium actually appears to be counter-cyclical. It is low during good times and high during bad times. So in good times, the return expectation is low, so the premium is also low. Risk premium is also low. This is what will happen in good times. In good times, the risk is low, so return expectation is also low. Sorry. In bad times, the uncertainty is higher, so the premium might also be required higher. So it is not exactly theoretically correct, right? So this is one problem with equity risk premium. Second is, as I already told you, that when you're looking at sample and all, you have sampling biases because you're looking at market returns of those securities and those securities which are surviving. So there is a survivorship bias and many other biases, especially related to sampling. So past always has this issue. Therefore, we look at forward estimates. Forward estimates or ex ante. Ex ante, you see this word again and again. This is basically forecast. It is not actual. Forecast. It is not actual, right? Correct? The reason of doing forward looking estimate is to get rid of the two issues that we discussed. The assumption of stationarity, that is constant, and problems related to survivorship bias, because here we are going to get rid of those two issues with related to historical estimate. While doing forward estimate, you are going to predict or forecast. They want you to take care of three main issues related to, or three main categories of forward looking estimate, right? How do people estimate the RM minus RF or risk premium? One, which is the easiest, and actually, when I was in the industry, I realized that this is actually more used, is survey estimate. What is survey estimate, everyone? Survey estimate, this is very common in US also, where the top analyst of the industry, a group of analysts of the industry, they take us, because these guys are doing in and out research day in and out all the time. So what we do is that we take an average opinion or consensus opinion or a survey of these experts, the selected experts, right? That's it. That is how US purchasing market index is also calculated, by the way. So that survey is taken, right, to estimate the equity risk premiums. Generally, the developing markets are more riskier, so their risk premiums are higher. Okay. This is the easiest and quickest way, but the weakness of this is, of course, it can be biased to the recent trend. So it can be affected by the momentum in the market, right? But this is the easiest and quickest, and actually this is very effective. Many people in reality use this survey estimates, which you can actually get from Bloomberg or Reuters also. The more common that we use in our theory is dividend discount model, right? Generally, dividend discount model is used to find the intrinsic value. Remember the intrinsic value formula? P0 is D1 over cost of equity minus G. If you rearrange this to find cost of equity, your cost of equity is D1 over P0 plus G. Of this, D1 over P0 is nothing but it is called your expected dividend yield. Dividend yield is dividend over price. And why I say expected? Because it is D1, futuristic. Growth is retention into ROE, right? So this is the second thing that we will use to derive the cost of equity. Here, very important, P0 current market price you can take. So it's actually also called the implied yield. It's not mentioned here, but it is just a rearranging of the Gordon's growth. And this is called my implied yield. Understood? Here, this D1 over price, this is my expected dividend yield, which I can get it from the past D0, right? I can forecast it from the past. So it is expected dividend yield. Remember, it's not about a stock. I'm looking for the market. Market is not a company which gives me dividend, right? So we take the average dividend of all the constituents in the index. So imagine in S&P 500, there are 500 securities. So what is the average dividend given by these 500 security? What is the dividend given by these 500 securities? Average of that is going to be my dividend yield. Got it, everyone? Right. The second term is the growth rate, which is again based on consensus forecast from the survey, right? This is what you can take the growth, correct? This growth is nothing but growth rate on the index, the general growth rate on the index. This is what we are estimating. Again, as I said, constant growth rate, you can assume what is the long-term growth rate in the economy. That is what you can consider, right? Now, when I say equity risk premium, it is RM minus RF. Now, the RM component of the index is what I have here, return, expected return on the market. That is my dividend yield plus growth. From that, I will subtract RF to get my risk premium. Understood, everyone? Correct? Yes, some of the things, recall that constant growth model assumes constant growth in earnings. We are assuming that the growth rate will be constant, right? But if the growth rate is not constant, then what should I do? If this assumption is not valid, analysts will need to include relevant expectation. And this is what we discussed in we discussed in economics. We are going to learn something that we discussed in economics called Greinhold-Kroner model that is going to come up. Okay. So For developing economies or emerging economies, where the growth rate is transitionary means it's going to change, we might incorporate multiple stages. This is also common with those companies which are startup, which are initially growing at high rate, then lower rate, and then constant rate. So it's a multi-stage model. Present value of all this valuation or all this dividend using different growth rate and different discounting rate, that is going to be a current value of the index. You don't have to do this in exam. Just remember the discounting rate used here to find the present value. That IRR is nothing but that IRR is your required rate of return. From that, subtract the risk free. That is going to be your one of the ways of calculating equity risk premium for emerging economies or developing economies. So what are we supposed to do here? Your equity risk premium is nothing but it's going to be IRR on the index value minus the risk free. That's going to be my equity risk premium for developing economies. Okay. This is what we are going to use under dividend discount model. So I will write down here. What are we now trying to do? We are trying to now calculate cost of equity. But before that, we are trying to find equity risk premium. Equity risk premium, which is your ERP. Okay. Now there are three ways to do so. One simple where there is no calculation, that is survey, where you take the consensus, right? The second is where we are using the Gordon's growth model, or it's called dividend discount model. Dividend discount model. This is where we have formula. And the third is going to be macroeconomic model, where I'm going to use a model that we used in the past, that is Greinold-Kroner model. So this is where we are going to use, first of all, it's called macroeconomic model. In this, we are going to use Greinold-Kroner model. Again, we use this in the topic of economic growth. Already, it's almost the same thing. Slight differentiation you will see, but for exam, there is no difference. So that's what we are going to use. Just writing here under dividend discount model, our equity risk premium, okay, formula, equity risk premium is cost of equity, right, minus the growth rate, and cost of equity based on Gordon's growth is dividend yield, that is D1 over P0, correct, plus growth, sorry, not your growth, my mistake, minus RF, that's my risk premium. So D1 over P0 plus growth, that's going to be my cost of equity, minus RF will be my equity risk premium under the option of under what? Yes, under the Gordon's growth. This is for index. But if I'm looking for an emerging market, here I will write down, this is all index cost of equity or index yield, you can say, right? But if it is for emerging market, then in that case, we will use the IRR. Why IRR? Because there we are expecting that whatever is the return on the emerging market in multi-stage, that return is going to be my cost of capital or cost of equity for that emerging market. And that cost of equity minus risk-free will be my risk premium. Don't worry, in exam, all will be provided to you to find cost of equity. Correct, everyone? Right? The important thing now is going to be Greinold-Kroner model under the macroeconomic model. We will use the GK model to illustrate the macroeconomic. And here, instead of repeating everything, what I'm going to do is that I'm going to exactly do what we did in the economics, is that we are going to write the whole formula. They have slightly changed the formula here. So I will perhaps be writing the same formula. Greiner-Kroner model, if you look at here, first we are trying to find the capital. Here we are going to find out again, before finding the equity risk premium, we need to find how much is the equity return. Or when someone invests in equity, they get two things: dividend yield and capital appreciation. So dividend yield component is very easy, D1 over price. But the capital gains yield, that's a complicated one. So Greiner-Kroner decomposes into two parts: dividend yield, correct, and the capital gains yield. But further, the capital gains yield is also decomposed into various components. That is change in PE ratio or change in pricing. And then nominal growth rate. Nominal growth rate is expected inflation plus real growth rate of economy minus the change in S. The change in S is change in the stock. This is what I will discuss. What is this? And that this CGY, capital gains yield plus dividend yield, together will give me my equity risk, equity return, expected return minus risk free will be my equity risk premium. So see what I will put up all together here. First of all, we are trying to find ERP, right? So watch out this. I will do equity risk premium, which is going to be my equity return. Here we are going to find out what is going to be the return on my equity. Again, so we are finding cost of equity, right? So again, I'm finding cost of equity minus RF. Here, the cost of equity will be decomposed first into dividend yield, expected dividend yield, and second is capital gains yield. So see, this is my dividend yield, and then CGY, capital gain yield. The entire focus is going to be on how to derive this capital gains yield. 1, 2, 3. It has three components. One is the change in the P ratio, which is called expected repricing, because we've done in economics. So here I'm just going to write down the formula, that is change in the PE ratio. Here we do nominal growth rate in EPS, nominal growth rate in earnings. But when I say earnings, I am talking about earnings of the index. So here nominal growth rate is nothing but the earnings of the index, correct? So this is going to be my nominal growth rate, which is again a component of nominal G, I will write to be short form. Nominal G growth, which is in reality real plus expected inflation. Okay, this is what we already know. And the last component is change in S. Now this S is change in shares, which reflects net share issued and buyback. Okay, so this three component together will make my capital gain yield. Everyone, this change in shares outstanding, this takes into consideration the buyback, correct? The shares that are bought back and the shares that the company has released. So the change in S, actually we wrote in economic growth minus change in S, which is nothing but net buyback and the shares which are issued, the difference between the both. Here we are going to assume what exactly? See this. Here, if you notice this, they have said expected inflation plus real economic growth minus change in S. See, tell me one thing. Your capital gain yield will be higher when there are more shareholders or less shareholders? When there are more shareholders. When will your EPS grow? When there are more shareholders or less shareholders, everyone in the class? Check, check, check. When the shareholders are more or less less. See this, that change in S reflects the net buyback of the stock. So this is NBB, net buyback. Okay, so whatever shares the company has bought back, what will that do? That will reduce the expectations. In the sense that will do what? That will be positive news. Why so? See this. So another way of corporations can effectively pay cash to their shareholder. If the change in S is positive, it's a dilution effect. Hence, it is subtracted. So in reality, change in S. What is change in S? Change in S. They are saying if the change in S is positive, it's a dilution effect. That means more shares are issued. So change in S here, they are saying net buyback, net buyback, net buyback. Again, in exam, they will probably provide you this, or most of the time the change in S is ignored. But for your reference here, to make it comprehensive and to include all the parameters, the change in S is changes in shares outstanding. So if the number is positive, that means more shares are issued. So the formula actually is issue minus buyback. Okay. So what I tell student is that don't fall into the trap of plus or minus. I will here write plus or minus. So this is nothing but issue minus buyback. Keep in mind, this is shares issue minus shares bought back. So if it is plus, more shares are issued. More shares are issued, then you require more yield. But if it's minus, some of the shares are bought back. So I'm happy with the returns expectation is going to be lower. Correct? Understood about change in S? Yes. Clear, clear. See this. Greinhold Kroner, function of 5 factors: dividend yield, change in the P ratio, real growth rate and inflation, they consider individually, and change in S. All these 5 components together, they give me my expected return minus risk free is my risk premium. In exam, everything will be provided. It's just the repetition here. The reality, however, here is that how do I find the inflation? So for expected inflation here, they have said us that you can actually calculate the inflation. For example, in US, how to find the inflation in US? The most famous bond after the treasury bond is TIPS, Treasury Inflation Protected Security, which are actually adjusted for inflation. So the ratio of both treasury and TIPS, that ratio reflects the inflation premium. So see this here, if I want to find only the inflation premium, this is very interesting. So see in the question also down there, if I just want to find the inflation premium, I need to look at what? I need to look at, if you see this, current 10-year treasury yield is 2.4 and TIPS is 0.25. So when I look at the ratio difference of both, you cannot take absolute number 2.5 minus 0.25, right? That will be approximately 2.15, not a big difference, but we take compounded. So how do we calculate this? We take the treasury yield 1.024 divided by 1.0025 minus 1. So if you do this, it will be close to 2.15. So 1.024 divided by 1.0025 minus 1 into 100, you will get 2.1446. So I will write down 2.14 percentage, geometric mean it is. This is going to be my inflation premium. So here, the expected inflation that you see, it is actually a ratio of 1 plus treasury yield and 1 plus TIPS, treasury inflation protected security, minus 1. This is how we get the inflation premium. Got it? Right? Now that is one component plus the rest of the component. Remember, change in the pricing. If they have not provided you, you can skip it. They've given me the dividend yield. The dividend yield is given. First component, change in pricing is not given. Real growth rate is given. Inflation, I got the fourth point, right? What is missing? Change in S. They have said there is no net change in outstanding, so ignore it. We ignore that also. Even this is 0. All of this will give you expected return minus the risk free that they've provided us. That is going to be my equity risk premium. Understood, everyone? All the components. These are the only ways through which we find equity risk premium. So check out here. Equity risk premium is simply based on consensus survey. Okay. Dividend discount model simply based on the Gordon's growth rate, right? But here it is based on Greinhold-Kroner model, same like what we did in economics. Clear, everyone? Check, 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 check. Right, everyone? Yes. Perfect. Till this point, everyone? Check, check, check. Actually, I'm not doing the question in between because then there is very interesting. At the last, they've given a case study which includes everything, debt, equity, all the variety of components put together in an amazing case study. That's where we will solve all of that together. And I would also want us to solve all of that together. However, now we are, since we've got equity risk premium, now we are actually going to go into the detail of calculating cost of equity in different sections, in different varieties, put all together, including we are going to see for international equities. We are going to issue for international equities or global equities, how to derive cost of equity. So there is cost of equity for public companies, private companies, international when it's a foreign security, and when it's a multinational, it's a global. So now we are, after understanding equity risk premium, now we are actually going to go into the detail of deriving my most important thing, cost of equity, that is KE. But there are four sections throughout the syllabus, which I'm going to chart out here. There are four ways of doing cost of equity. If you look at here, now we are going into understanding cost of equity. So there are several approaches. Number one is dividend discount model, but all of these are for public securities. Those are listed. Correct. Then dividend discount, bond yield plus risk premium, risk-based model. All of these are for public securities, including CAPM, right? Multi-factor model that you've done in equity, pharma, French, right? Three factor, five factor. Then the second is for private or unlisted companies. Third is for those companies which have international operation, right? Foreign operations. And last is for those companies which have multi-operation, multi-country operation, that is for global companies, multinational companies. So there are four sections of cost of equity. One is for those companies which are public but domestic, private, domestic. Then you have international, and finally you have global companies. So now what we are going to do, we are going to derive cost of equity for these companies and different varieties. What we will see, many of these things you've already covered in the topic of equity, so a lot of things will be repeated, but summarizing all, when to use which one, that is going to be critical. And since there's a lot of information, I am happy to put up all together at one place. Eventually this slide and these three slides will be sufficient for you to do any questions related to cost of equity. So let's start with cost of equity. Again, very smooth, very easy. Most of the things you will see, we have already done that in the past. Everyone comfortable till this point? Yes. Okay. So let's start now with cost of equity because we've already covered the equity risk premium. Remember, equity risk premium is anything which is over and above the risk free, right? So now cost of equity, most of the cost of equity components we've already calculated in equity valuation. So it's more of going to be a repetition. But as I said, cost of equity, first we will start with those companies which we know are already listed because their prices are available. So it's very easy to calculate the cost of equity for those companies. And first part, we are going to do it for public companies. As I mentioned, public companies means those which are listed. Here, we are going to use four models under the public company. That is the dividend discount model, bond yield plus risk premium model, build up, and the risk premium models. So let's see for most of these things you are familiar with, right? So the first model is the dividend discount model, which is based on Gordon's growth. Remember, as I said, Gordon's growth is used to actually derive price, which is D1 over cost of equity minus G. The CFA Institute writes cost of equity as R, required return, but which is the same thing. If you rearrange this formula, your cost of equity is D1 over P0, that is expected dividend yield, plus the growth rate, which we discussed in the Greinol-Kroner model. You can separate this into two components, dividend yield and capital gains yield. Right. Here we will take market price. So we will get the implied returns. The returns we will get is implied return. It can be single stage or a multi-stage. Here you are basically going to take the current market price and derive the discounting rate using the cash flow function of IRR. So whatever is your IRR, that's going to be your cost of equity under this model, whether it's a single stage, multi-stage, or two-stage or three-stage model. So how are we going to do that? We will take all the components, find the IRR. Okay, let's see that. Company is expected to pay a dividend of 4. So that is my D1. At the end of first year, dividends are expected to grow at the constant rate of 4% per year. Correct. Current price is 100. So this is going to be my outflow, right? In the cash flow function, I will put this as CF0 negative. Remember to put this as CF0 negative. Dividend will be 4, correct? Betin, Betagenics is expected to pay a dividend of 1.5, 2, 2.5, and 3 at the end of the next 4 years. Okay, respectively. So they've given us the value. So this is company A, company B, right? The current beta genetic stocks is 50. So this is going to be my cash outflow for this particular stock, expected to be 60 at the end of 4 years. So guys, in the case of first and in the case of second, we are going to find the cost of equity. Remember, cost of equity is your IRR. If you see in the first case, is it multi-stage or single stage? In the case of Cogenics, is it single stage or multi-stage, guys? Yes. It is single stage, right? Because they said the dividend is going to be 4D1, correct? Price is given to me, right? And I need to find the growth rate, which they've given me. The growth rate is 4%. So it's a constant growth model. So my cost of equity will be D1 over price plus growth. D1 over price plus growth. So my D1, 4 over 100, that is dividend yield, plus growth is also 4%. That's going to be my cost of equity, simple, for the first company. For the second company, since it's multi-stage, right? My cash outflow, what is going to be my cash outflow, guys? 50 is going to be my cash outflow. Now, what is going to be your next year dividend? D1, D2, D3, D4. And in the fourth year, they've given me the price that you will get when you sell the stock. That is 60. So guys, in my cash flow components, what will be my cash flow components? You don't have to do this equation. We will do CF0 as negative 50, C01, C02, C03, and C04. Yes, everyone in the class. C01 will be 1.5 dividend to 2.5. And guys, 1, 2, 3, and the last one, C04, sorry. C04, can someone help me? What will be my C04? Yes. Everyone in the class. My C04 will it be only one thing or two things? It will be two things. 3 as dividend plus 60. Right? Correct. Put all of these functions in your calculator, cash flow function, and find the IRR. That's going to be your cost of equity. Everyone with me? Just confirm me if you get the answer. Check. Very easy. Right. Just confirm me once you get the answer. Are you getting the answer? 8.78. Don't forget to put CF0 as negative. That's your outflow. And the fourth function, fourth cash flow will be dividend plus the price. Everyone getting this? Check. Easy. After doing equity, this is going to be just a cakewalk, right? Easy. Okay, this is what we will do when the prices are available. Sometimes we use another approach, which is related to bond. So tell me one thing, is the company's bond riskier or equity riskier? What is riskier of a company, bond or equity? Of course, equity is riskier, right? So the other approach that we are now going to see, many students find it stupid because it is quite illogical, but we just use one of the approach, is the bond yield plus risk premium. So whatever is the company's bond YTM, right? That YTM we take and plus add a subjective risk premium. Risk premium can be anything that the analyst assumes, right? Generally, here your cost of equity again is a YTM on your company's bond plus a subjective risk premium. This YTM is generally taken for a long-term bond because equities are long-term. So you take long-term debt into consideration. Okay. So this is a build-up approach, correct? Right? Where we will add a risk premium to the YTM of the company's long-term debt. Understood? Everyone, risk premium, either you can take historical or you can just have a subjective estimate. The more historical, if you take historical, it is quite evident that that is going to be working up. Like instead of taking any subjective random number, mostly people choose the historical risk premium. Got it? Again, this is not a perfect approach, but there is no perfect approach for equity because everything is subjective in equity. So this is one of the approaches. What we are going to do here, we will simply find the bonds YTM. So they have given us a 15-year bond with a maturity coupon. Price is given to me, right? All of this will be sufficient for me to find the yield. So N will be 15, coupon will be 8.2, right? Annual coupon. Price negative 101, FV will be 100. If you calculate I by Y, you will get 8% as your I by Y. Then add the risk premium of 3.8. Very simple. Easy. Everyone in the class, right? So two approaches we are using. First, until now we've used the dividend discount model approach. And now we are using the bond yield plus risk premium approach. So first approach is the dividend discount model. Second approach is the bond yield plus risk premium approach. Everyone with me on this? Clear, clear, clear. Dividend discount model here, my cost of equity is D1 over P0 plus growth. I'm just calculating it for single stage. Multi-stage, you are aware. Bond yield plus risk premium here, my cost of equity is long-term debt yield plus risk premium. Everyone with me? Check, 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 confirm. Till now, right? Again, these are for securities which are listed. Okay. Now we are going to move towards the risk premium based model, and the risk based model, the most famous model that we've done throughout our syllabus, that is your CAPM model, which is a single factor model, isn't it? CAPM model. And do you know the multi-factor model, Pharma French? So single factor model and multi-factor model, which is my Pharma French model. Okay. CAPM, we all know what is the CAPM. Cost of equity is RF plus beta into risk premium, isn't it? That is RM minus RF. Very easy, right? Then we will go into the multi-factor model where there are more than one betas or more than one factors. So after understanding the bond yield plus risk premium approach, if I go to the capital asset pricing model, RF plus risk premium, that is RM minus RF into the beta, very easy. No brainer here. They've given us the beta, they've given RF and RM. Easy. No brainer here. I'm not going to waste your time here, right? Correct. CAPM, remember CAPM is a single factor model, correct? It is very easy to derive from the market model, or you can also relate it with linear regression. Isn't it linear regression? Remember the linear regression equals to y equals to b0 plus b1x. So it's similar to that, right? Here, if your company is unlisted, you will not have the beta. Then you will have to take the beta of a company which is listed, lever unlever. Lever unlever means adjust for leverage and then recalculate the beta. Fortunately, this is not a part of your syllabus in level 2, but you have to readjust the beta for leverage by taking the identical company's beta. Don't worry, that is not asked in level 2. So you just have to remember that you can borrow the beta of an identical listed company. All right. This is the model that we use CAPM. Very easy. Multi-factor model, which is the fourth option, which is also what we are aware. In multi-factor, there is more than one factor. We've already discussed in length this in cons, in equity, in many places, right? So here my required return is risk-free plus risk premium into the sensitivities, more than one sensitivity. Pharma French has three-factor model also, and Pharma French has a five-factor model also. So they have a three-factor Pharma French model. They have a five-factor Pharma French model. And you will notice here there is a three-factor Pharma French model. So within the Pharma French, both are multi-factor. There is also another model by Carhart, right? So in Pharma French, the three-factor model, and here the five-factor model. Of course, you don't have to now just memorize it. It is going to be natural for you. So here you will have risk factor, risk free plus the three factors into their sensitivity. Here, two additional factors. So I'll just walk you through what are the factors here. Apart from the market factor, market factor is there in the Pharma French three-factor model. But apart from the market factor, which is also there in CAPM, what are the other two factors? The other two factors are due to size and value. Size, small cap and large cap, correct? Returns of small cap and large cap, and value stocks is the difference between high book market value to low book market value, the difference between the both. In a five-factor model, you add two more additional factors, and these factors are due to what? Due to the profitability premium. So, which is also some people call in Carhart, it is called momentum factor, right? And then there is investment premium. Again, you don't have to remember, but this is related to whether the investment is conservative or aggressive. So it's a comparison between two. And when I say profitability, it is whether the profits are higher than expectation or lower than expectation. That is robust profit or weak profit, which is to a large extent related to momentum. Do I have to memorize this? No, just remember three-factor and five-factor model. In exam, they will provide you risk-free return. And if they ask you cost of equity, all you have to do is add the risk premiums into the beta. So risk premium into the beta for whatever factor, whether they give you two, three, four, five factors. One, two, three, four, five. You will multiply these. Store one, store two, store three, store four, store five, and risk-free. That's going to be your cost of equity. Very easy, isn't it? So here, my cost of equity is simply risk-free plus beta into the risk premiums, which will be continuous, right? It can be three-factor, four-factor, five-factor. Generally, it is either going to be three or five-factor model, correct? That's your multi-factor model. These are the cost of equity for public companies. Now we will move to private companies because public companies we were already aware. For private companies, we can't use CAPM or Pharma French. Why? Because we don't have their prices or their betas, therefore, and which companies are more illiquid? Private companies are illiquid. They have lack of transparency. So generally, they will have higher risk and therefore higher premium. So the extra premium that private companies have apart from public companies, those are three. Due to the size, because private companies are smaller in size, industry where they belong to, and company specific premium, which is generally what we call as the unsystematic risk or company risk. Company risks, everyone in the class, company risk. Some of the risks are easy to diversify, some of the risks are complicated to diversify. But specific company risks, how do we analyze it? We are going to analyze it using qualitative and quantitative factors. So, how to estimate the specific company risk? Specific company risk, I'll repeat, is the unsystematic risk, is the risk of the company individually, right? These risks can be due to the business that the company is into or due to company's own decisions. Okay. So we will check the qualitative and the quantitative factors. I'll repeat to analyze the specific company risk. Why are these risks important? Because for private companies, these are extra risk compared to public companies. So it's just a theoretical discussion. For example, qualitative factors are the business or the industry in which the company is, whether the industry is concentrated or fragmented. Understood? The the companies, sorry, uh, asset nature and types. What do I mean by asset nature and types? Does the company have more tangible assets or intangible assets which are illiquid, right? Concentration of the customers, quality of your corporate governance, right? All of these are qualitative factors. How well is your management? Is your management more transparent or not? Easy to give the they are they giving relevant information or not? Correct. How is the competitive standard in the industry? Is it highly competitive, or is it difficult to enter into such businesses? All of these factors will tell me whether the risk is high or low. These are just the qualitative factors. Quantitative factors is where I'm going to calculate some of the numbers, like the leverages, operating and financial leverage. Operating leverage is if the company has high fixed operating cost. Financial leverage is when the company has high debt, right? The volatility of earnings and cash flow. Is it too volatile? Then the company is very riskier. Then the risk premium will be higher. Got it? Of course, if the company has debt, the risk is higher. All of these factors put together will help me identify the additional risk premium that private companies have compared to a public company. Based on this, we are going to use two approaches to find cost of equity for a private company. Here, we will use expanded CAPM, right? That is one of the approach. And the second approach is the build-up approach, like bond yield plus risk premium, but it's a slightly different build-up approach. So we are going to use two approaches, expanded CAPM, the first one, and second is a built-up approach. I will write here, expanded CAPM, expanded CAPM, and second is a build-up approach. Now, expanded CAPM is just same as CAPM, but here you will add the additional risk premium. So what we did in CAPM is that we took beta into the equity risk premium to the risk-free, correct? So we took the risk-free. So I will write down the same thing that we did. We took the risk-free plus beta into equity risk premium. This was common. Plus, I will now add a few more risk premiums. What are the few more risk premiums I will add? As I said, for the size, for the value, or for the specific company risk. So we add for see here, we add for the size of the company, whether it's a small cap or compared to the public company, industry risk premium and specific company risk premium. So these additional risk premium we add for the size, for the industry, whether it is concentrated or not, and for the company specific risk premium. So we will add for size risk premium. I will write size premium, right? Or simply said SP, industry premium, and specific company risk premium. So it's a long term specific company risk premium. These three additional premiums you add because the company is not listed. Understood, everyone? Correct. Easy, right? Okay. In exam, they will provide you all of this. Just see the expanded CAPM approach, right? You have RF plus beta into equity risk premium, right? And then you have size and security, and which this is the specific company risk premium. Now you will notice that what about the industry risk premium approach? What do I do about industry risk premium approach? That's in the build-up approach. You will see all three there. But in the build-up approach, you will notice one thing. What is missing in the build-up approach, guys? In the build-up approach, you will notice that the beta is missing from here. Are you noticing that, everyone? Correct? The beta is missing. So in reality, see, there is one minor difference. It starts with CAPM, right? and then adds risk premium as needed. So it is RF plus beta of the company which is listed, peer group, plus the different risk premiums. This risk premium, one mistake that I see in the note is that there is industry premium missing. So guys, you will add the industry risk premium also here. I don't know why did they do that. So no bit of other risk premium for size industry. Okay. No, sometimes they added it, sometimes they missed it. Okay. In the latest note, it is not existing, but in the previous books, they had taken the industry risk premium in both the cases. So here, required return for expended CAPM does not have industry risk premium because they are assuming that the peer is also in the same industry. So it already captures the industry risk. Okay. So when I'm doing expanded risk premium, I can skip industry risk premium if the beta is for the company from the same industry. So if the beta is for the peer group, then I need not take the industry risk premium. But in the build-up approach, which is similar, what we are going to do is that we are going to find the same thing. We are again going to calculate cost of equity using the same approach. But now there is one thing missing, that is there is only risk premium. Why? Because we are assuming beta is 1. Why is that we are assuming beta 1? And then I will add for the different types of risk premiums. So then I will add for all the risk premiums in this approach for size, for industry and company specific. So for size premium, industry premium, and specific company risk premium. Now you will notice the difference is that here I have taken industry premium. And why have I not taken the beta? I have not taken the beta because in this case, in the build-up approach, what we do is that I'll just show you. Why have I not taken the beta? Not taking the beta means I'm assuming the beta is 1. And why is that so? Because in the build-up approach, we add risk premium to average large public company. And this public company, guys, need not necessarily be from your same industry. So I am trying to calculate required return for my company, which is from a different industry. And I'm taking the average large cap, let's say Apple company's beta, but Apple is not in my same industry, right? So large company beta is generally close to 1. Why? Because index is dominated by large cap companies. So large cap companies beta is generally close to 1. So therefore here we haven't taken beta. We haven't taken beta means we've assumed beta is 1 because large cap dominates the index. Got it? But since that company and my industry is not same, therefore we add the risk premium also, the industry specific, which I did not do here. Why? Because here I did not add the industry risk premium because the peer group is from the same industry. Are you getting my point? Everyone? Clear? Understood this? Check, check, check. Clear, clear, clear. Perfect. Got it. So overall, I have same, the required return is same here. If you're using peer companies beta, you don't need to have the industry related premium because it's already added in the beta. But if you're using any other large cap company whose beta is close to 1, right? Then you need to add the specific industry risk premium also. Is this clear? Everyone in the class? Right? Now we will look at cost of equity for those companies which have business or subsidiaries abroad as well. Here, the assumption is that you are sitting in US, so you are in a developed economy, right? And you have business outside US also in an emerging economy, which is relatively riskier. So you need to add the country risk premium also. Are you getting it, everyone? Correct? So whatever is your equity risk premium of developed market, add the country risk premium also. What is country risk premium? Is the extra risk for investing in that country. And how to derive that country risk premium? There are two approaches to do that. One approach is based on the YTM spread. Do you remember what is spread, guys? Spread. What is spread? Yes, spread is the difference in the yield, correct? Between the emerging market, which is riskier, and between the developed market bond, isn't it? Everyone, that's how you get the spread. That spread is your country risk premium. So your country risk premium either can be derived by taking the spreads of both the country's government bond, which are called sovereign bonds. So therefore it's called sovereign yield spread, which is difference in the yield of emerging and government emerging market government bond and developed market government bond. Are you with me, everyone? This difference in risk is due to legal, market factors, and various other factors. It is simply the yield on the government bonds of both the countries. That's your country risk premium. Everyone with me? How to derive country risk premium? Country risk premium, one way. Other approach of finding country risk premium is, of course, you should take sovereign yield spread. But see, you are investing in that country's equity. And you always know equity is more riskier or bond is more riskier. Equity is more riskier. So the bond yield spread will only reflect the bond risk, right? Equity markets will be more riskier. So the other approach is where we take the sovereign yield spread, but multiply that with the ratio of volatility in equity and bond market. Sometimes the equity markets and bond market have same volatility in emerging markets. Then it will be the same. But if the equity markets are more volatile in emerging markets, this sovereign yield spread will be multiplied. It will be magnified. Are you getting me? So if the equity market is twice as riskier as the bond market in the emerging economy, then the sovereign yield spread will be considered twice. Are you getting me, everyone? This country risk premium multiplied with lambda. What is lambda here? It is how much is the economy and currency related, in the sense, how much is this company, okay? How much is my company exposed to that economy? This is basically, here the lambda represents that what is my exposure to that particular local economy. Now, what do I mean by that? What exactly do I mean by that? First of all, the exposure maximum can be 1. Means, let's say I'm exposed 50% to that economy and 50% to domestic economy. Then my exposure is 0.5. The maximum exposure, I will write down here, it's not mentioned here. Maximum exposure can be 100%, which is 1. You cannot be exposed more than 100% because you have domestic exposure also, right? You have international business, so you are exposed some of amount to domestic market, some to that specific emerging market. Maximum it can be 100%, not more. Correct? Everyone in the class? Understood? Understood? This is called my country risk premium. So when it comes to international considerations, we add country risk premium. Very, very, very important. So international market, I will just write down the name here. We add country risk premium. Now, how to derive country risk premium? What I will do is that I will copy down this formula again, and I will use the approach where I will erase all this so that I can write down the country risk premium thing, right? So here, what we are going to do is that we are going to derive equity risk premium for our company, which is an emerging market company, which is same as developed economy plus the lambda, that is the exposure into the country risk premium. Now, this country risk premium, guys, can be derived using two approaches. One is sovereign yield spread. Sovereign yield spread approach. Okay. And the second is Damodaran approach. Very interesting. Who's Damodaran? I'll let you know in a moment. So sovereign yield spread and Damodaran approach are almost the same. Sovereign yield spread is simply the yield on two bonds. On the yield on which two bonds, guys? Yes, the yield on or the YTM or yield, whatever you mention, YTM on emerging market government bond, and this is on a developed market government bond. That's your sovereign yield spread. But Damodaran, Aswath Damodaran, very, very famous professor of NYU. Okay. This is the guy because of whom I actually did CFA. He is the master of valuation. So this guy is very prominent in the industry of valuation. I started my CFA journey by watching his videos way back 15 years back. So this guy has done a remarkable theories in the world of valuation. So this guy has come up with several phenomenal valuation approaches, including for the stock of Apple that you would see if you go to the YouTube. So Aswath Damodaran, basically this professor from NYU Stern, I think right now he's the dean of NYU. So this guy said, no, don't only take sovereign yield spread, but the country risk premium needs to be adjusted for sovereign yield spread plus the equity market risk relative to the bond. So here we take sovereign yield spread and then we take the ratio of the standard deviation of that emerging markets equity to the emerging markets bond. So emerging market equity to the emerging market bond market, right? So this adjustment we do if we are taking the Damodaran approach of sovereign yield spread, that sovereign yield spread multiplied with the lambda, which is maximum 1. The lambda is maximum exposure is 1. Maximum is 1. This will be provided to you in exam. That will give me equity risk premium using the international approach. This is called as ICAPM or international approach, not ICAPM, just the international CAPM. It's here we just add the risk premium, which is the country risk premium. Everyone with me? Understood? Right? The reason is that I'm going to combine all of them together and then we are going to see the case study. Got it? So this is what we do when we are valuing for or when we are trying to get the cost of equity for companies which have international operation. But then there are some companies which have global operations. Global operations. They are present in multiple countries. When they are present in multiple countries, we use two approaches. All are dependent on CAPM. One is the global CAPM approach and second is international CAPM approach. What is the difference between both? In global CAPM and international CAPM, there's not much of a difference. Again, see, all of them are dependent on CAPM. That's what was derived by Professor William Sharpe, and because of which he got Nobel Prize in economics. All the global valuation theories are based on discounting models, and discounting model requires discounting rate, and discounting rate, the one to derive the best discounting rate was CAPM, which was by Professor William Sharpe. Now, when I'm looking for global companies equity discounting rate, right? I will use global CAPM where we use the beta and the market RM minus RF, right? To find the equity risk premium, what do I need? RM minus RF. So here, what is that RM? The RM here is a global market index. Global market index like MSCI, Morgan Stanley, Composite Index, global market, right? Such global market indexes you will take. Those index returns will be your RM. But then what about the beta? See this. Because of low correlation between developed and emerging markets, the beta coefficient of global market is usually quite low. Yes, if I'm going to take the beta of global market, the risk will be lower because global markets have less risk compared to emerging markets. So then what do I need to do to overcome this? Second factor for local market is also added. So for global CAPM, guys, here honestly there is no calculation. All you need to understand is that for global market, you will take multiple betas. You will take the beta of the global market, and you might take additional beta and risk premium for that emerging market. Now, again, you don't have to worry about the formula because that formula is going to be mentioned to you in the ICAPM, which is a two-factor model specifically done to include this. So global CAPM and ICAPM. So for global companies, we use global CAPM or GCAPM and ICAPM, international CAPM. There is formula for international CAPM because it's a two-factor model. So two-factor model means here we are going to derive the equity risk premium or expected return on a company which is global, which is a two-factor, which is RF plus beta into RM minus RF only. But see, the beta into RM minus RF will change. So here my cost of equity is RF plus beta into Rm minus Rf and again beta into Rm minus Rf. But these betas belong to what exactly? Why am I taking two betas? Because in the international CAPM, I will take the beta for a global market index, right? But as we already said that emerging market might be having more risk. So then we add second thing, that the foreign currency denominated wealth weighted index. So that's a more comprehensive index because that's actually that foreign market index in foreign currency, which takes the currency risk also into consideration. So here I have two beta. One is for global market, right? And second is for foreign market in foreign currency. See this. So it's a global market beta into the risk premium and foreign market in foreign currency. So let's say this is a global market. What is global market index? You can take any global market, Morgan Stanley or many other indexes, which are country index, global indexes. So they've given you some references, have they? Have they given you some references? Have they given you some references? No, they haven't given, right? You can assume one of the very famous indexes, which is a global market index, which is MSCI. MSCI, did they use? Yes, they have used here. MSCI All Country World Index, which is a global index. Okay, but global index beta will be low. Second index is the foreign currency index in foreign market. So this can be MSCI Emerging Market Index in, let's say, foreign currency. So this can be MSCI Emerging Market Index. Okay, right? Sensitivity for the foreign currency index. Now, this is emerging market, this is global market. So simply here you will take a global market and you will take emerging market index. Both will be provided to you. You don't have to worry about it. That will be your ICAPM model. Understood, everyone? So here, the first factor captures the global economy and the second factor captures the sensitivity to the local market. Got it, everyone? Overall, after understanding different approaches, we need to conclude which approach is the best. Well, there is no answer. It depends on what is the objective. What are you trying to find the cost of equity for? If the business is global, right, everyone? Global operations that are limited to developed markets only, then you can go for these global CAPM or ICAPM, right? Because here your market concentration is not too high to the emerging markets, right? But if your exposure is too high to the developing or emerging markets, which has more risk, in that case, you need to add the country risk premium. So country risk premium is only making sense if your exposure is more towards emerging markets. Are you with me, everyone? Correct. So the confusion students have is, should I use this or this for my business? If the exposure is more towards emerging markets, then add the country risk premium. If not, you can use the ICAPM or GCAPM. Clear, everyone? Right? Okay. Finally, we are going to put all that together in the calculation. So now let's start doing calculation after understanding all of these formulas. So this is an amazing topic which summarizes all the different parts of cost of equity or cost of debt. Basically, it focuses on WACC, right? The most important topic. I've seen this topic not only tested in exam heavily, but also in interviews, they ask you this, right? So let's do the case study, amazing case study they've presented. And in this case study, we are going to cover everything that we've done put together. So the reason I did not do one by one question is that we wanted to see how we can pull up all the information together and solve this, right? Let's directly hit the question. So here I'm also showing you the technique how to save time in exam. So there are 6 questions. Imagine this is one case study asked in exam for corporate issuer. Very high chance of this being asked in exam. Okay. So this type. So based on information in exhibit 1, Sai should conclude that relative to country P, country Q's cost of capital would most likely be. Now I realize that this is related to exhibit 1. So I go to exhibit 1, I will compare both the companies and they ask me which company's cost of equity will be higher. Okay. Relative to company P, company Q's cost of equity. So what we will do is that we will go to exhibit 1 and you have to tell me which company will have higher risk and therefore higher cost of equity. Isn't it, everyone? Easy? Correct? Let's find out that in exhibit 1. Country P has a common law. Guys, common law provides more protection compared to civil law. So civil law is more riskier. Whichever is more riskier, I'm tick marking that. Got it? Capital markets are less developed in country Q. So this will be more riskier. And volatility of currency is also high. So the country will be more riskier. Is P or Q, everyone in the class? Q will be more riskier. And therefore, guys, its cost of equity relatively should be. Yes, come on, come on. Its cost of equity relative should be higher, right? This is what I realized. Now I'll go back to the question and I will see what they had asked me. So they said relative to country P, Q's cost of equity should be naturally everyone in the class. It should be higher or lower? Higher, isn't it? Isn't it? High currency risk and high all the other factors that they've presented. Clear, clear. Okay, now see how you save time in exam. I haven't read the entire case study. Okay, we are just following whatever we can get directly so that we save time. Otherwise, we'll have to read everything. Based on information provided in Exhibit 2 and 3 and elsewhere. So you'll have to look at other things also. The after-tax cost of debt for Sizemore. So 2, 3 and elsewhere. So I have Exhibit 2, Exhibit 3 and otherwhere. We are looking for after-tax cost of debt. First of all, what is after-tax cost of debt? Cost of debt into 1 minus T. So I naturally require the tax rate which I have here is 34%. So I know cost of debt means cost of debt into 1 minus T. So whatever is my cost, I will deduct 34% tax rate. This is clear in my head, right? Now, guys, I will look at information of Sizemore, its revenue, blah, 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 everything is given. After analyzing hundreds of securities, Sue arrives at the metrics for interest coverage, financial okay, and credit spread relative to the benchmark, currently yielding 2.3. Guys, 2.3 is the credit spread. Okay. Now, what am I supposed to do? They have given me 2.3 as the credit spread. Everyone in the class, here my information, they've given me information for the company. What all information, where do I belong to? 2.3 is the spread. 2.3 is the spread. My rating class is given information, interest coverage ratio, Financial leverage, credit spread relative, currently yielding 2.5. What credit spread should I be looking at? What should be my credit spread, everyone in the class? How will I identify? They have given me credit spread, the extra, that is 2.3, right? I need to now look at all the ratios and understand where does my company fit into. So first of all, they ask me for interest coverage. Guys, what is my interest coverage ratio? Can you tell me what is my interest coverage ratio? Interest coverage is EBIT over interest, right? So how much is your EBIT and your interest? Can you find interest coverage ratio, everyone in the class, for our company? Let me know your interest coverage. 3421 divided by 814. 3421 divided by 814. I get 4.2. Remember, interest coverage, higher the ratio, better it is. So interest coverage is where 4.2. So it is greater than 4 and less than 5, right? Second thing, they ask me financial leverage, that is debt equity. So I will look at my debt equity ratio, that is total debt I have here and total equity. So I will look at 8671 divided by 17342. So my debt to equity ratio is 0.5. Am I correct? So let's look at 0.5. Debt to equity 0.5. So it's between 40 and 52, same, right? Everyone in the class? So the spread should be 1.2. The current yield for the benchmark is 2.3. Everyone in the class. So what should be my spread additional 1.2? So guys, what should be the YTM belonging to me? The risk-free benchmark is 2.3 plus 1.2. My YTM will be 3.5. Am I correct? Check, 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 check. Yes or no? 3.5, 3.5, 3.5. Very good, right? But remember, you have to do after tax. Don't forget to do tax. They have a trap. See, they have a trap here. Don't fall in that trap. So guys, my cost of debt, after tax cost of debt, I had 3.5 into 1 minus 0.34. That is into 3.5 into 0.66. You will get 2.31. Don't fall into the trap because you need to take after tax cost of capital. They know students make this mistake. Understood, everyone? Got it? Clear? I've got a question. Why 1.2? 1.2 is the spread that I need to add over and above the benchmark. So these are different spreads depending on where your ratio is. If my ratio falls into this, I will be getting a spread of 1.2 over the benchmark. Benchmark is 2.3. Understood the question? Clear, clear, clear. 2.3 is for risk-free. 1.2 additional. Right? Very interesting, isn't it? Amazing question. Next, which statement made by C regarding the equity risk premium are correct? Statement 1 and 2. Has he said any statement about equity risk premium? Yes. Let's look which one is correct. Okay, everyone in the class, please let me know. The arithmetic mean of historical values of equity risk premium provides the best estimate of terminal value. Guys, is it arithmetic or geometric? Arithmetic, no. Geometric is best, right? So this is a wrong statement. Correct? Forward-looking estimates of equity risk premium, either historical or forward. Forward is better because it doesn't have bias, right? Do not suffer from survivorship bias and do not rely on it being stationary. Correct or incorrect, everyone? This is a correct statement. Yes. So only statement 2 is correct, right? They ask me which one is the correct statement. I will say only B. Everyone with me? Check, check, check. Right? Perfect. Got it? Now we are going to use exhibit 4 to find equity risk premium using Greinhold-Kroner approach. Remember equity risk premium using Greinhold-Kroner approach. What does it need? Yes, 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 yes. It's dividend yield and capital gains yield. plus capital gains yield minus the risk free, right? Because you're finding the risk premium, isn't it? Isn't it? So we will require the dividend yield, capital gains yield, and minus the risk free, right? Capital gains yield have many other things. Let's see one by one in exhibit 4. Exhibit 4, expected dividend yield is given to me. Very good. PE growth rate, change in PE is also given to me. Real GDP is also given to me. Changes in shares given to me. But for inflation, they've given me this. How to find inflation? We take the treasury yield 1.0267, divide by the tips 1.0033, correct, minus 1. That's going to be my inflation premium. So 1.0267 divided by 1.0033 minus 1 into 100, you get 2.33 percentage. That's your inflation premium. Am I correct, everyone? Now add all and subtract the risk free. So first of all, I will add all. So it will be 1.1 minus 0.1 plus 3 plus 2.33 plus 0. Are you getting 6.33? From 6.33, you need to subtract the risk-free. Have they given you risk-free return? Have they given you risk-free return? Have they given you risk-free return? They've not given you risk-free. Guys, if they don't give you risk-free, then what is the risk-free I will take? I will take the 10-year treasury as my risk-free, isn't it? Well, if they give me, no problem, but they haven't given me. Are you there, everyone? So minus 2.67, I will get 3.66 percentage as my equity risk premium, 3.66. Got it, everyone? Check, 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 confirm. Guys, very important. The risk-free, I didn't had the risk-free. They didn't provide me risk-free separately, but I know this is my risk-free. If there is no risk-free provided, this is itself is my risk-free. Clear? Right? Very important thing. Next, based on dividend discount model, cost of equity. So I will have to find the dividend discount model, whether it is single stage, multi-stage. Let us see that. They said he compiles the estimate. Okay, Sizemore is expected to pay. Expected means D1, right? In the next 3 years, in each of the next 3 years, and the stock is expected to be 34. Current price is 25. Guys, did they say there is going to be a growth? No, they did not say growth. So what you need to do is that you need to put 1 as PMT. Put PMT annuity as 1, N you put as 3, N as 3. FV at the end of third year, you will get FV3, and this has to be your negative PV. And then find I by Y. So 25 negative present value, 34 is FV, 1 is PMT. Why am I taking an annuity? Because they said dividend is going to be 1 only. 3 as N and compute I by Y. Are you getting 14.42? Everyone? When you compute I by Y, you will get 14.42. Check, 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 check. Understood? Perfect. Yes. And the last one, how many factors considered by SAI would support a higher specific company risk premium for Minicure? See, for Minicure, the risk premium is going to be higher. We have to look at all the factors and see how many of this will support higher risk premium. Higher risk, more risk premium. Okay. The choice is only one, two, or all three. Okay. Only one, all two, or all three. So that means definitely there is one factor, right? Minicure's founder is the chairman and CEO. Chairman and CEO. Guys, when the chairman and CEO is a single board, not two boards. Single board is risky. The management team is comprised of team of scientists whose research initially led to development. Guys, tell me, should the management of the company be made of scientists or those who are good in terms of managing the company's finances and operations? Should they be mostly made of scientists? Scientists are good with research and development. But do you think they should be the managers of the company? If majority of the managers are scientists, is it appropriate or not? First of all, Minicure. What is this company? Psy collects information, ponders how they might have affects this Minicure company. What is this Minicure? Is it risky? Let us see. Industrial, pharmaceutical, okay. Two countries, Sizemore and Minicure. Sizemore is a large cap company, right? While Minicure is a privately held company with a single drug, which was approved by FDA. So it's a private company, just one drug, concentration, highly concentrated. And guys, the company is privately, so its size would be lesser and its management has mostly team of scientists. Will this cause more risk premium or less risk premium? Everyone in the class, this will cause more risk premium relatively because it's riskier. Understood, everyone? Second, the value of the patent on Mitra. Mitra is the only drug that it has, represents 90% of total asset. That's a concentration risk. So this also supports higher risk premium, isn't it? And the third, subcontract Samita handles commercial production of Mitra because Samita is the only company that has the necessary supplied equipments. So guys, you do not only have customer concentration, but you also have supplier concentration. So this is, I would say, customer concentration. This is supplier concentration. You are so much dependent on one customer. You're so much dependent on one supplier. And your management is mostly included of scientists. Okay. And your company is relatively small because it's a private company. All of these factors support everyone in the class higher risk premium. Everyone with me? Understood this? Clear. This is 2.31, right? Okay. Everyone, check. We've covered everything. Perfect. That's it. That's the end of your one of the very interesting topics of cost of capital. And we have covered with so many formulas. All of this formula, generally, I recommend this specific topic to be immediately done along with equity. It's very easy. So you will not find it too complicated. You can actually understand all the versions of different variations of cost of equity. Perfect, everyone. All set. Check. Clear? Yes. Any questions, anyone? Right? Okay.